Recording in progress.
Well, hello, my friends. Let's have a little discussion, shall we? Let's talk about 2026 and how to invest with certainty in 2026. We'll talk about some of the themes that I see that are out there, and then just really, I think, some really easy ways for us as investors to align to whatever may happen. And the reality is no matter what themes are out there that are postured as these are the things that are going to come to play, it never fails that there's always something else that is in play. So, what are the ways that we can be certain when so many other things are uncertain? So, we're going to do a little bit of a look at what are some of those headwinds, how might they play out, and then we'll spend the bulk of our time really just looking at, well, how could we show up in a certain way and get the outcomes that we want in our investing, regardless of what happens. So, with that, let's dive in, shall we? So, as always, just reminding you that one of those things that we can have control over is risk. So, if you want to have a certain approach to investing, you want to think about how do I be not risk averse, because there's no opportunity without risk, but how do I be aware of the risk? If we've not met, my name is Josh. I'm the founder of Miiflo, and we're an investment tech company, and we are here to help you navigate uncertain waters by providing a platform that can help you access tools and capabilities that have largely not been accessible to self-directed investors for a lot of years. And there's a lot of reasons around that, but there have been some changes in technology recently that have really opened the door, and we're here to help you leverage that so that you can have better outcomes. Well, let's start in with a couple things that I'm noting as we go into 2026. So one is that the world is getting riskier. Okay, and what do I mean by that? I mean that the house of cards that is being stacked is ever getting taller, and there's a number of ways that we can measure that. Here's one of these. So this chart here represents the number of assets under management that have gone into something called a leveraged ETF. So this is assets under management of leveraged ETFs. So let's do a little history. In 2008, there were about 8,000 publicly traded companies in the United States. Today, there are 4,000. So there's been a lot of mergers and acquisitions that have consolidated that significantly. At the same time, though, there are about still 8,000 products that are investable. So what is this other 4,000 products? They are exchange traded funds. So exchange traded funds were the brainchild of Jack Bogle at Vanguard. The idea was that rather than trying to construct a portfolio that would match a specific index or sector and have to own those individual stocks, I could just buy this fund that did that automatically. So a number of them that we really are fans of. So one is the SPY, that is called the Spiders. It follows the S&P 500, and you can buy Spider shares and have the same directional exposure as the S&P 500. There's one called the Triple Q from Invesco that allows you to do the same thing for the NASDAQ 100, IWM for the Russell 2000. So these are really great products that allow you to simplify your investing if you want to have exposure to a basket of names. Now, that being said, there's been a significant change of late, and that's where this chart comes back in play. So leveraged ETFs, all right, leveraged ETFs is what happens when you decide, you know what, I don't necessarily want just one times exposure. I would like 2 or 3 times exposure. So you can buy this ETF, which will increase your directional exposure. So let's say that the S&P does 10% for the year. If you were in a leveraged ETF that was a 2x ETF, you'd do 20% for the year. Okay. All well and good. There are 2 and 3x ETFs. I think that's the most that I've seen. Okay. It can be a way to more efficiently use capital. However, what are we seeing in behavior, and what is always indicative when the world gets riskier, and there typically tends to be a form of check on that, is the not only just the growth in these leverage ETFs, which that has exploded, but there are now ETFs that are what we call single stock ETFs. So, for example, there are ETFs just on NVIDIA. Okay, so NVIDIA has been a big name, a lot of the thing that's been driving markets in AI and growth and data centers and chips and all of this. But leverage ETFs in NVIDIA, where they're 2 and 3x times NVIDIA. This is concentrating risk, and it's around one name that's pretty volatile. And we're seeing participants going into these products. So a really good clue that things are at risk and we should be aware is when we see participants chasing and engaging in products that are increasingly risky. And that's one of the things that we're absolutely seeing. So you can see really from 2020, this has just absolutely gone parabolic in terms of the amount of growth each year. And I don't see that going away. What else do we see out there? Well, so in 2008, less than 35% of Americans had exposure to stocks. Today, that number is greater than 75%. And I think I saw recently that Treasury Secretary Bessent had said that he wanted to have all Americans have exposure to the stock market. Okay. Well, imagine how bad 2008 was. If we had that again, but you had 2x the exposure in terms of who it impacted, it's going to be really, really bad. I'm not saying that we're going to have that, but when you start, the more, this is just a fundamental insight, the more you expose people to risk, the greater the chance that you're going to have that risk. You know, it's like if you don't want to get struck by lightning, don't run around in the rain with a lightning pole. Okay, so we're seeing more and more of this running around with a lightning pole. We're also seeing, and this is connected also to the leverage ETFs, is we're seeing more and more concentration around where growth in markets is coming from. So this is not what we'd call broad-based growth. This is what we'd call really concentrated growth. In 24 and 25, for example, 9 companies drove 90% of growth in U.S. markets. If we look at what we'd call the Mag 7, these are 7 big tech companies, you can see the growth of these companies just in terms of their earnings per share relative to the rest of the S&P 500. So these 7 companies have driven almost all of the growth for the rest of the 493 that are in the S&P 500 for the last number of years. This is risk. When you have more concentrated risk and expectation in a more concentrated spot, this is putting us in a place where if that has a hiccup, it can significantly impact things, right? So let's say this came unwound for some reason. I'm not saying that it is, but if it did, if this drove growth, could it drive negation? Absolutely. The math could support that. Now, at the same time that I say that, this is now going to sound like I'm talking out both sides of my mouth. We're now at a point where I think that the SPX is becoming too big to fail. So what do I mean by that? Beginning around the late 90s into 2000, we really started to see this shift away from companies paying pensions and people are into 401ks and IRAs and retirement funds. That has only ever increased, right? How many people do you know in your family or in your friends that actually have a pension, right? So they're saving for the retirement, but that's in market exposure, meaning that it is a risk vehicle. It is not guaranteed. Okay. However, because there's so many Americans that now have exposure to this, we've had some events where there has been exposure to the markets, and we know what is the playbook. Both politically and from a policy standpoint, is that if we were to have a significant movement negatively in markets, which is going to impact a lot of people, we could expect that the powers that be pull out all the stops to ensure that that comes back. So when we look at the COVID drop, for example, or the tariff drop early this year, policy decisions were made very, very quickly to keep us from continuing. Okay, so that combined with some other market mechanics that have continued to evolve over the last number of years. Really, I would say since 2023, regarding options, and we'll talk more about those lately in a little bit, have kind of set up a recipe where we can still see pretty big drops. How long they'll last, not, I don't know. So what can we expect is we can expect that, hey, yeah, continuing to have exposure to the S&P 500 is a good thing. There is in a sense a bit of a insurance to that, despite the concentration risk, despite the ETF risk. What I would say as a summation of that is, because of the concentration risk and because of the leveraged risk, we're increasing the probability that we're going to see wiggles. Okay, so when we are increasing the probability that we're going to see wiggles, what do we do about that? Now, it's not wiggles that are going to, that just everything's going to explode, because we've got this backstop from a policy and both monetary policy and government policy. So if that's the backstop, then we can stay in it. We just need to think about how do we address that, and we're going to talk about how to address that here in a second. What are some other headwinds out there that you will undoubtedly hear about in the next year? One is that debt doesn't matter until it does. Okay, so this is a chart that represents the best investment I've made in 2025. And it's probably too small to read, but essentially what this is a relationship of interest rates to each other. So interest rates, when we talk about interest rates, there are different maturities of interest rates that are out there. And the Federal Reserve, who controls the interest rate, we get a little bit of a market holiday or national holiday. We celebrate it about 8 times a year when the Fed makes a decision on interest rates. So they control the interest rate that sets what banks can lend to each other overnight. So we call this the repo markets. So let's say you have a bank that doesn't have enough cash to cover its deposits. It can go to an overnight repo market from another bank and loan and get money in a loan to cover its need, and they pay a very small interest rate. That rate is set by the Federal Reserve. And so all of the other maturities, so this is that's overnight, but they that Fed prime rate, which goes to 2-year, 5-year, we actually have their futures contracts that allow hedge funds, banks to hedge interest rate risk that are in maturities of 2, 5, 10, 30-year maturities. Okay. Now, because the Fed is impacting the short end of this curve, typically what we call a normal curve, the further out in time you are, the higher the rate, because you're paying for longer things to be in play. But in relationship to what's happening right now and why this chart worked is essentially we've been seeing policy trying to push interest rates lower in the short term. And because the Fed can impact that thing that is in the front end of the curve, or the shorter durations, from a macro government and trade policy, the things that are being done are inflationary. And the only antidote, or one of the only antidotes to inflation over time, is to raise interest rates. So while we've been seeing cuts in the shorter term interest rates, we've been seeing the longer term interest rates continue to hold. And that distance between these two is only widening. And you can actually create a position that allows you to benefit from that macro shift. Now, because this is holding here, and there's been, some would say, aggressive forces to push the shorter term rates down for a short period of time, what is likely to happen at some point? Okay, so in this coming year, in 2026, we're going to get a new Federal Reserve chairman. And I believe, will see the full froth of what we would call Nixon 2.0. So if you know your presidential history, Richard Nixon was president in the 70s. He installed someone as Federal Reserve chairman by a guy named Arthur Burns. Okay, Arthur Burns was a sycophant. He really was put in place as the board chair at the whims of Nixon, who wanted the Fed to cut rates despite them not being needed to spur growth. Okay, so economics 101, if you cut rates when it's not needed, as in when you have persistent or increasing inflation and you cut rates, you essentially only fuel the fire when that happens. What I think is going to happen as we go into 2026 is that we are going to get a new Fed chair, and that Fed chair is going to very quickly move to try to cut rates on the short, or basically the Fed rate, very aggressively on the short end. That's only going to make this thing move wider, because eventually, as is the case in the 70s, will be the case again, is there will be a snapback. And we will see, whether that happens in 26 or whether that happens in 27, we're going to see the shorter end interest rates catch up. It's not inconceivable that we could see a 10-year rate that's at 10%. If you have parents or grandparents that bought a mortgage for a home in the 80s, and they will talk about having a 16% interest rate, this is not outside of the realm of possibility if this all plays out the way that it could play out. Now, what's the thing that's driving? Like, why do they want the rates lower? It really is about debt, and it's about corporate debt. The United States has about $35 trillion of debt as a nation. There's about $9 trillion of corporate debt that needs to be refinanced in Q1 of this year, of 2026. That debt was issued in kind of 5-year or 10-year terms, and it was issued under 200 basis points. We're at 375, 350 points right now. So the general prevailing idea is they need to get it another 150 basis points lower, so that all those people can refinance their debt. And then guess what? After that, they don't care. And so then, as was also the case with Arthur Burns, is he got into a place where he had to start aggressively raising rates to counter it. And it did not end well. So I hope that's not the case for us now, but that is something that's there. What does this also allude to? It's the idea that there's likely going to be wiggles, okay? What's another potential thing that's out there that could lead to some wiggles? And that is this AI bubble story, okay? So actually when, this is from Goldman Sachs, but, this is Bank of America, put this together, but they surveyed a number of fund managers, and they asked, for 2026, what do you consider the biggest tail risk? So what is tail risk? Tail risk is when you have a distribution curve. So if you ever did statistics, you have a curve of distribution. It's the outlier things. What are the outlier or black swan events that could kind of take the whole house of cards down? As we look towards 2026, the one that is most cited is the AI bubble. Now, we've talked about bond yields, inflation. We haven't talked necessarily about trade war or private credit or some of these things, but this AI bubble, and what is that? It's related to that first idea where I was talking about the number of companies that have really driven all the growth. They are spending at a rate they cannot sustain, and different from the U.S. government, which can print its own money as long as it can find people who are willing to buy the treasuries, which they're having a little bit more trouble with that. But they're spending way more than they are making, and at some point that music is going to stop. Also around that, there is the problem of that the way AI is talked about right now, it is essentially just a really aggressive learning algorithm that has already sampled everything there is to know that's available on the public internet. So it has now exhausted the information that's there. So in a sense, the AI that we have is the AI that we have. It's a great tool. I use it every day. It's been really, really powerful. It's really helped us develop Miiflo faster than we were even hoping in some ways, which has been great. But the current models take about $10 billion each to train. So every time there's a new model that's generated, ChatGPT 5 or 6 or whatever, it takes $10 billion and massive amounts of electricity that are now starting to cause some really interesting wiggles. Even this last weekend, we saw a black swan event in silver. Okay, so what's going on in silver? I mean, silver being part of what's used in all of this AI value and supply chain, and China is going to put in place export limits on the 5th of January, I believe, and we saw silver move a 6 Sigma event in one day. This is a black swan event. These are the types of events that say, hey, things are more susceptible to a crack. Again, doesn't mean that they will, but these things are out there. Now, there are always things like this that are out there. So whether it's interest rates, whether it's the bubble, whether it's debt, whatever it is, I mean, there's always going to be some headwind. And what we've often seen is we've seen markets continue to push higher. And in fact, the aside from the fact that the SPX is, I think is becoming too big to fail, I mean, the natural position of market participants is the expectation that things will go higher. In the absence of really good concrete headwinds, things will go higher. That's kind of been the play. Okay, but now as we go into 2026, I would say that of the last 5 years, we have the most headwinds that we've had that I can remember. So what do we do about that, and how do we come into that? So let's now shift this presentation and talk about, okay, what's kind of my go-to? What am I looking to do in 2026? How am I going to align around that so that if any of these things have an impact or none of them do, I can still move my investing goals forward? Okay, so let's start here. The first is 6205 to 7600. So this is, as of today, the expected high and or low of the S&P 500 as of December 31st, 2026. Okay, so we can actually already model the expected range. It's about 900 points. Top to bottom is expected in 2026. So that gets us to about 7,600, give or take. It's like 70% of that range to the upside, because, we're not going to go straight from, up. But it could be within this range. What this says is this is about a 70% probability, so the normal distribution, that we will close at the end of 2026 between these two prices. That's already baked. Okay, that's the most probable outcome for 2026, is that the S&P 500 will close between these prices. So what would I do about that? First, have bullets to buy drips, or buy drips, but buy dips. What do I mean by that? Let's just look at the performance of the year-over-year return of the S&P 500 over the last 10 years. And we'll note that of late, like the last, this would be 3 years in a row that we've had double-digit gains in the S&P 500. On average, we may have 3 years of something positive and then a negative year. The record is 5 years in a row that we have positive years going forward. But you can see, we've had some good growth at the same time that we're reminded that the 20-year average of the S&P 500 is still just 6.7% inflation adjusted. So we've had some pretty banner years in terms of growth here. If we want to be successful as we go forward, we want to think about, okay, how do we stack probabilities in our favor, and then leverage the reality that with these headwinds, we are more susceptible to have wiggles. How would we use the wiggles? So I want to present kind of two use cases here. So one of these is investor A and investor B. So let me talk about investor A and investor B. I get asked a lot from friends to take a look at their investment portfolios. That's not under my registration. So I carry Series 3, guys that do the 67 or 6. But friends ask me, hey, what do you think? Okay, I can tell you, you make your own decision. But what I see over and over again is just kind of the way that the industry works is to be 100% allocated at all times. The prevailing idea is that you don't want to miss out and you don't want to time the market. Okay. This is really bad advice. One, it assumes that we're okay with a 6.7% inflation adjusted return, because that's what ends up happening is when you just, kind of just keep dollar cost averaging this thing, you really are resigning yourself to, what's that 20-year return. You can get better returns if you're willing to be a little bit more nimble. And that can just be as simple as knowing that in about every year, of those last 10 years, we saw a 10 to 15% pullback or 20% pullback in each of those years. All right. So what happens if I'm fully allocated and we get a 20% pullback versus I have money on the sidelines. So that's what I want to look at and encourage you to have bullets available. So rather than being fully allocated to something, have bullets that you can spend. So let's walk through these two scenarios. So if you're investor A and you're fully allocated, okay, we get a 20% pullback in the markets. We now have to appreciate 25% to get to break even. So that, after we move 25%, which we're at 19% for the year, it could take a year to get back to break even. You've weathered that dip. Okay. Whereas if you had, let's say, 20% in cash and you deployed that cash when you saw a 20% market correction, okay, once that got back to break even, you would not be at, back to where it started from. You would not be at the initial contribution. You would now be 11% higher. And I used 100% or $100,000 just to make the math simple. But you can look at this and see the difference between these two scenarios. Having bullets to spend, especially when we see some headwinds out there, is a really, really good way to have greater certainty on getting towards our outcomes. So have bullets to buy dips. Okay. Next one. Don't buy narrative, buy process. So the prevailing wisdom within investing is thus: hey, if I like the narrative of the company and I like what they're doing, then I should own that company. Okay, now what's the benefit of this? The benefit of this is that this can align you toward what we would say is an in-play stock. Okay, so when our Miiflo model looks for potential investable stocks or ETFs every day, we look through those 8,000 that I mentioned. We really find that there's about 270 to 300 that are worth anyone's attention. Okay, and typically those are the ones that you hear in the news. People are talking about. Just the tribe being aligned to that is things that will add to movement in those markets. What it does not tell us is to where, to what price, and how much exposure should I have to that specific vehicle? And is the growth that I've seen that's pulled me in, has that been something that has already kind of taken place? And if I participate now, well, now I'm too late. Buying narrative can open you up to lots of risk that is really undefined and really scary. I don't recommend it. What I do recommend instead is to buy process. Use a process in the way that you invest, which you could use of a company. But let's say that you had stock X that you were going to buy. Use these four questions that we use that are embedded into all of the drips that we generate for Miiflo in the way that you approach that. First is, what is the opportunity? So if I'm going to buy the stock at X price, where am I going to sell the stock? Okay. And this is that's going to be a new approach for many, because the idea is, well, I'm going to buy and hold. I'm going to hold this forever and it's going to perpetually go higher. This is not the path of most stocks. Okay. So if I'm going to buy this, where do I intend to exit? Because if I don't know where the exit is, and I don't have a hypothesis around that, I probably shouldn't be invested in this. Also, if I don't know where that opportunity or price target is, I don't know how to right size the risk. Okay. It's true that if we want to have opportunity, if we want to have returns from the market or any market, we need to take on risk. There's an element that we can't control, and that's what we're essentially paid for as investors. But we can be smarter and wiser about how we deploy that. So if I buy a stock and I believe it's going to, I've got a good case that it's going to make another $50 of appreciation over the next year or so. Okay, well, how much am I willing to lose on that stock? Am I willing to lose the same $50 the other way, or $10? I always go for asymmetric bets. So if I believe there's a price target, I set that first, and then I look for some price I can defend that is asymmetric to that reward, so that I'm always taking ideas that have a greater potential for return than what I'm willing to risk for them, right? Next to that is, now that I'm committed to this, how should it go? How will I know that I'm right? Every investor is a storyteller. So, in some ways, this is kind of connected to that narrative idea, but it's got more structure to it. How would I know that I'm right? And then how would I know that I'm wrong? If it's not playing out the way that I would like for it to play out, well then let me get to the sidelines and reassess. We don't have to just stay in and try to fight this. That's where a lot of damage happens in our investing. So, just to give you an example, here are ideas that Miiflo has generated for today's session, December 30th, 2025. And every single one of these have built into them these 4 questions. So like if we look at this one, that's the Miiflo pick. This is HYMC. It's an iron condor. Okay, so let's see what this is. This is Highcroft Mining Holding Company. Makes sense that mining, that there's been a lot of movement in silver and gold and metals this year. Miners are in focus. So what is the 4 questions within this? So the idea is that from our model, as long as HYMC, which when this was generated, it was at $23.26 a share. In fact, we'll save it and we'll see what the current live prices are. Okay, so when it was generated, it was 23, so it's now at 24.57, so it's appreciated a little bit. But you can see from the reference price, which is here, that purple line, the white line, we're here. As long as this stock stays between these 2 prices, so 1762, 36.38, you can see them here as the abandoned prices here, abandoned upper and lower. We will see, if it does that for the next, until February 20th, okay, the maximum profit per spread, which would be entering these 4 option contracts, is going to be $238. So the maximum that I can get out of this is $238. Now, how much is it going to cost me to get in it? It's going to cost $262 to potentially make $238. Now, let's talk about the risk reward aspect of that. An iron condor, because of the way that our model generates these and the way that we structure these, when you enter this, there is an 80% probability that you'll see 50% of that max profit. So that max profit was $238 per spread. So what, $115? 80% chance you're going to see that. That's about a 45% return on capital, 40%, 50%, somewhere in that ballpark. I'm fudging the math in my head. Return on capital in about 45 days. Okay, so what's the opportunity? The opportunity is that HYMC is in a position where the Miiflo model believes it's going to go sideways for 20 days. It's going to stay between these 2 prices. If it does, I will get $238 for every $262 that I deploy as a maximum potential. Now, that's not what I'm aiming for. I'm going to aim for about $120 because that's a higher probability I'll get that smaller amount. Okay, great. So what am I willing to risk? I'm willing to put up this amount of money. However, if we trade past one of these 2 abandoned prices, I'm out. So risk is not just a dollar amount. Like if everything went haywire and this stock just went ballistic, the maximum that I can risk per spread is $262. And I'm okay with that. That's a percentage of my portfolio. It's not the whole thing. How will I know that I'm right? Well, every day that I'm in this and we stay between these 2 prices in this chart is how we should be. If we get out past either one of these, then that would be an indication that I'm likely not right and I need to get out. Now, what's the beauty of this type of approach as a drip type is that it's going to take a bit for this stock to get to any one of those prices. The time it takes to get to any one of those prices actually would mean that by the time I get to them, if it abandoned, is probably close to break even or a very small loss, if that. But at least I know it's clear and I know how I'm using the 4 questions to inform this decision. So this is a great investment idea because it's honoring these 4 questions. I know how to know that I'm right. I'm going to be between these 2 prices. How do I know that I'm wrong? I get past these prices, right? Like that process I can repeat. And that's the type of process, like within our model, we just reran. If I'm following those types of processes, these are the types of returns that we can see. So this was a $10,000 account. It's got close to 17,000, about 16.5 as of right now, just running our model. Okay, and how does this happen? This happens as a result of higher probability ideas capital allocation, and risk management, all which are attainable. And we try to make that really, really easy on our platform. But this is, I mean, that's a 70% return. Now, am I expecting everybody's going to get a 70% return or that we're going to do that every year? No. But let's be reminded of if the benchmark is 6.7%, if I take a little bit more ownership as a risk manager, then I can get much better outcomes. As we're doing this, kind of the other insight around this is that, we can't guarantee outcomes. We can never guarantee outcomes, but we can stack probabilities. And how do we stack probabilities toward those types of outcomes that we want, even in an uncertain 2026, is using process, having capital available, okay? Is shifting market dynamics in that, favoring nimbleness over macro bets. I have seen a dearth of information around, here's the stock to own for the next 10 years, or here's, should buy gold or buy Bitcoin. I've heard those cases. I think there's some merit to some of them. Macro investment is the most difficult investment that exists because it's really, really hard to price. You find that the firms that really, really do well in the macro thing are just so well capitalized. They just had exposure. Even Ray Dalio, who I really am a fan of, that's a founder of Bridgewater and has been going around talking a lot about some of the debt hurdles and things, and has been a proponent of gold and Bitcoin as those that would benefit through some unwinding of things. He's like 1% exposed to those, and yet it's parlayed as if he is just massively exposed to these things. So he still understands, yeah, I'm going to keep this within my process. I'll have some exposure to it because I think it follows the narrative, but it's hard to price. So I'm not going to just go, all in on that stuff. All right. At the end of the day, what I would say is that, like, the absolute best thing that you can do to have certainty in your investing in an uncertain 2026 is to invest in yourself as a risk manager. Okay. Skilling yourself up. And then this is what we have been working on with Miiflo and will continue to work on with Miiflo, is how do we make you a better manager of your investing? How do we help you have more control, more skill, more aptitude to do this, but it not consume your life? Okay. You don't have to, what's one of the great things about Miiflo is you don't have to read reports. You don't even have to know what are the in-place stocks. We found those out for you. Like when I look at the flow even generated for today, the companies that are on this list, these are the in-place stocks. It's got to load them up here for a second. But if I look at, okay, we've got gold. Yep, absolutely. Ethereum is in play. We've got China is in play. We have the triple Qs. Like this is silver. Like all of the names that anybody's talking about, our model's finding, but it's doing it in a nimble, risk-defined, process-ordered way that allows you to contextualize it and address it, but also know what to do if it doesn't work out, because sometimes they don't. The thing that we can absolutely have control over is where do we apply risk and how do we apply that, and we have control over ourselves in relationship to that. That's a really, really powerful tool to lever. And that's the thing that I would encourage you to do, especially in the world that we live in now, and especially with where the technology has allowed us with Miiflo to go. I mean, it's very true. Today, we have the ability to access an investing playbook that benefits whether markets go higher, lower, or sideways. Okay? So what if the market goes lower next year? Okay. What if the market goes sideways next year? Okay. What if the market goes higher? Okay. Like having a playbook that's nimble enough to address those is the way to go. I'm reminded that, at the beginning of this, we talked about how we're kind of approaching a Nixon 2.0 type of moment, or already in it. But during the 10 years that was all being unwound, on an inflation-adjusted basis, anyone who bought the S&P 500 lost money from a purchasing power standpoint through those 10 years because the inflation was so persistent and so challenging. What would be a really bad outcome is that you spent the next 10 years putting money into a savings account that actually lost purchasing power through your diligent savings. And I think this is actually why we're starting to see more and more articles around this concept of what we'd call financial nihilism. There's a generation of Americans who say, I'm doing all the right things. I'm saving, I am diligent, I'm prudent, and it's still not going to get me what I hoped to have. And that's really discouraging. But the counter to that is it doesn't have to be that way. We can turn two dials, right? We can get into a playbook that allows us to benefit whether markets go sideways, up or down, by being more nimble. Rather than committing to these large macro bets, we can say, hey, what's something I can express in a risk-defined way over the next 20 to 40 days? And how do I, curate that mix? Like, we try to make that as simple as possible for you to be able to do that. And what's the difference in that outcome, right? I think it really goes back here. If I follow the existing playbook and I weather whatever 2026 has, and I look at 6.7%, I'm basically gonna need to put in 23 grand next year and the year after that and the year after that and the year after that for 35 years to get to $3 million, which is now kind of the bogey that is said that someone needs to have a comfortable retirement. What does that mean? It means that you'd have about 150K a year in income in 35 years. Okay. But if you turn the yield wheel to 30 or to 15%, you need $3,000, a fraction of that 23,000. If you move it to 25%, which I believe is very achievable, especially using the ideas with Miiflo and the risk management around that, you need $300 over that 35 years. That is doable. That is achievable. That's worth going after. And to that end, and as I land the plane here, I'd leave you with this. Benjamin Graham is the father of value investing. He actually wrote a book called The Intelligent Investor in 1949. He said, investing isn't about beating others at their game. It's about controlling yourself at your own game. So how do you face the uncertainty of 2026? Is you be certain in yourself. And we will be with you all along the way, continuing to evolve the platform, continue to stay out in front of it in the places where we can go do that heavy lifting, and we're happy to do that so that you can get the outcomes that you're looking for. So I wish you all a great 2026. I hope that it is everything that you hope for and more. I hope that we navigate all of whatever is out there. I'm sure there will be these things, and there will be other things that we don't even know yet that will come along. And it'll be a wonderful, interesting ride. So we'll talk to you in 2026, and feel free to reach out should you have any questions or things that would be helpful for us to know as we continue to develop this platform. Cheers.